Folks, I want to talk to you about something fun, cool, and I'm actually going to show you some examples today. So it's one thing talking about things, but when you actually see it with your eyes, it's a whole different world. So I want to talk about the VIX Index. This is the Volatility Index. Why is it important? Why is it relevant? How can it help you collect more money in 2020? Let me show you. And actually, what I'm going to talk to you about today is very scientific. It's not based on just opinions. So now, the US market, the global market, volatility markets, they take fear into account. They take greed into account. Remember, markets are still based on human emotions, okay? So whenever you have human emotions, you have different opinions on fear and greed. And what implied volatility, or what the volatility index does, is it reflects that fear or greed in the value of the option. So if for example, let me give you a good example. Let's say that the stock market believes that there's going to be a war with Iran, possibly. Not out of the realm of possibilities, right? Well, the at-the-money options on the S&P 500, which are measured by the 30-day volatility. So in other words, the options price in what could happen within the next 30 days. That's what this VIX reflects. This VIX is the fear level that's being generated by the at-the-money options on the S&P 500, for lack of better terms. So this allows us to measure the amount of fear in the market. And in 2020, we've got a lot of things on the table. We've got elections, we've got impeachment, we've got Iran, we've got China and US trade war, which people are all of a sudden forgetting about because phase one is here, and now that Iran is, everyone's talking about Iran. But the bottom line is this: when implied volatility, when the VIX level is low, premium, the amount of money that you pay for an option or take in if you're selling an option, is lower. So low volatility is really good for option buyers. But the problem with low volatility is low when there's nothing going on, when fear levels are low. So it's one of those things where if fear levels are low, options will be cheap, but there's really no catalyst to make them rally. So it's one of those situations. It's kind of like, anyhow, when volatility is high, when VIX spikes, it tells us that there's fear in the market and options across the board swell up because volatility is expected to increase. All right. Now, I'm going over this kind of slowly because I want to make sure you guys understand exactly what I'm saying, because these are not beginner concepts, but I'm trying to simplify them as best as I can. The bottom line is VIX is an index that tracks the 30-day volatility of at-the-money options on the S&P 500. The S&P 500 is our benchmark, at the at-the-money options give us a good barometer of the overall fear level of the market. And that's why we use the VIX, and that's what it's for, to tell us how fearful or how greedy the market is. The lower the volatility, the more greed you will see in the market, the more bullish the stock market will get. The more fear exists in the market, the lower the market will trade and the higher the VIX will get. Now, as you could see here, over the past year in 2019, and this is, let me go to it, this is a 10-year chart. If you look at the VIX over a year, this is May 19, let me go a little further back. Let me go back 2 years. We've had some spikes. So whenever VIX is at 11 or 12, that's a low volatility level. But whenever you have fear of war, threats, impeachment, stock market turmoil, the VIX will rise. And over the last few years, VIX has been going down. But it looks to me like VIX is about to rise. And why? Because volatility is mean reverting. Volatility typically goes back to its average. And with all of these factors that I've talked about in 2020, such as impeachment, threat of war, the possibility of Trump and China continually doing this and not working things out, there's a good chance that volatility will rise. I mean, a really good chance. And when volatility rise, that's an expectation that the fear level on the options, on the broad market, Amazon, Apple, Microsoft, all the other stocks that I'm not going to mention, will rise as well. And when that happens, it gives you more premium as an income trader, substantially more premium. Now, you're probably thinking, I don't understand what he's saying. It's probably not that important, but it is. And let me show you something. I wanted to do this just for fun. This is the Dow Jones, the DIA, the diamond. Now, most of you know the Dow Jones is a blue chip. It trades blue chips, got 30 blue chip stocks, the Dow Jones. We all know that, okay? So blue chip stocks don't have a lot of volatility in comparison to tech stocks, right? They have a lot less volatility. Look at the price of the diamond, 286. If you look, and the expiration is the 17th of January. And I'm showing you this to show you the example of what volatility can possibly mean for the price of an option. So you've got options expiring on the 17th, and the price is 286. So if you look at at-the-money options, the price of an at-the-money option is going to be $1.39, $1.40. If you go one strike in the money, it'll be $2. If you go one strike out of the money, it'll be 90 cents. So let's look at Apple. Apple's price at $298, it's only about, a little bit more than $10 higher than the price of the diamond, right, of the Dow Jones. But Apple is a tech stock. And whereas the DIA fluctuates a couple of dollars a day, Apple can fluctuate $5, $6, $7 a day at times. All right. So I wanted to show you the same expiration. See 117, 117. Look at the price of the options for Apple around the at the money, $297.50. They're about $6, $5.93. All right, let's say I'm off one. Let's say $4.73. So you got money that's close to at the money between $7.50 and $4.73, whereas the Dow Jones, I keep saying spider, but we're looking at the Dow, where you're looking at the Dow, which is just priced also right near that level. You've got options between $2.89. Now, why is there such a difference in the price of near the money or at the money options? The reason is volatility. Let's look at the price of Apple. Let's look at the price of Apple. I want to show you this. Apple fluctuates on average sometimes $7, $8 a day, as you could see here. Like right here, low is 285, high is 290, 269, right? But if you look at the DIA, you will see that it doesn't fluctuate as much. Here's that same trading session. It only fluctuated $1.50. So the more volatile, the higher the VIX, the more volatility exists in the market, the more trading range exists in the market. And the more trading range exists in the market, the more the option price will balloon up. And the price of the Dow at the money option that I showed you here, and this was a straight comparison. This was a apple to apple comparison. I wanted to say apple to orange, apple to apple, but we're looking at Apple. But this is a straight comparison. So you could see now, imagine the price. So let's say VIX increased in value, went from 14 to 20. The Dow Jones would increase in volatility. The trading range, volatility and trading range are the same. And that means the price of these options could possibly swell up from being $1.83 to possibly being worth as high as $5 or $6. So we're not talking about implied volatility or VIX getting higher and having a 50-cent difference in the price of the option. We're talking about the price of the option possibly ballooning, being worth 2-3 times as much. And that's why 2020 is the best time for income opportunities, because we expect the VIX to rally. We expect the volatility level in the market to rally. And I wanted to explain this to you in the most simplest way possible and actually show you some examples of how the VIX, or the volatility of an asset, can have an impact on the price of the option. So VIX is really important, and I think in 2020, it's going to spike. Folks, I got something really exciting for you. Now, if you want to take advantage of elevated VIX levels, you've got to check out this video from my friend Rob Booker. In the video, he'll show you a strategy that takes advantage of volatility to generate a high and consistent income stream. And he just proved anyone can do it. In the video, Rob shows everyday folks can rake in paychecks of $784, $903, or even $1,150 in just a few seconds. And as you'll see, it's a very easy strategy to execute. This video is coming down soon, so if you want the details of the strategy, make sure you click the button below. Watch it now. Get in on this.